It's your boy C Lemons with the hacks. So we have already covered your retirement account and you may want to begin investing in stocks, but don't want to go through the hassles of looking over individual company financials or researching the CEOs of a company to see the trajectory of revenue. So exchange traded funds or ETFs may be your calling, as well as tapping that like button and subscribing if you are new to the channel. ETFs allow investors to easily build a diversified portfolio due to providing broad exposure across many asset classes, industries, and geographies. This diversification can help an investor reduce risk without sacrificing long-term returns. Some ETFs that will sure give you some good returns are the ticker symbol VOO, or the Vanguard S&P 500 is designed to track the S&P index. That index represents 500 of the largest U.S. publicly traded companies. This ETF's goal is to closely follow the index's returns, which is primary benchmark for the overall returns of the U.S. stock market. This ETF uses a market weight strategy, meaning the largest company within the fund are given a higher weighting. As a result, the top 10 holdings make up more than 30% of the total net assets in 2022. This gives investors concentrated exposure to the largest companies in the index. The ETF offers investors exposure to the largest stocks at a very low cost. The expense ratio of 0.03% is significantly below the industry average of a ratio of 0.24%, meaning that you will pay $3 annually in management fees as opposed to paying $24 per $1,000 invested with the average ETF. If everything is making sense and you are tracking, type tracking in the comments and let's get to the second suggestion. Next is the ticker symbol RSP, or the Invesco S&P 500 Equal Weight ETF, which also tracks the S&P 500 but uses an equal weight approach instead of the size of the company or market capitalization. This ETF's top holdings represent just 2.5% of its total asset. This approach reduces the concentration risk by providing broad exposure across the 500 stocks in the S&P 500. The ETF rebalances itself and the holdings quarterly to ensure each holdings remain relatively equal portion of the fund's assets. This ETF also has a low expense ratio at 0.2%. Even though it's a little bit higher than the previous, it's still below the ETF average, meaning you'll only pay $20 annually for every $1,000 invested. Lastly, we have the ticker symbol SCHD, or the Schwab US Dividend Equity ETF, which focuses on dividend stocks known for the quality and sustainability of their dividend payments. This ETF enables you to benefit from the power of dividend. This ETF held shares of more than 100 dividend-paying stocks. The fund offers a dividend yield of near 3%, which is far more than that of the S&P 500. Its top 10 holdings made up about 40% of the total assets. The ETF charges an extremely low 0.06%, which allows a significant portion of the dividend income to be kept by the investors. This makes this ETF a very low-cost way to collect passive income via dividend stocks, which are a great long-term investment. ETFs can be great building blocks for investing for the long term. They can provide broad exposure to the market sectors and industries never considered before. This allows investors to diversify their portfolios and reduce their overall risk. I hope you have enjoyed this content and this has helped you on your journey of investing. If you would like some free stocks or crypto, reference the links in the description and let's get your investing started. Thanks for watching. As always, like and subscribe if you are new to the channel, and as always, stay tuned for some more military hacks.